Innovate. Enable. GIC RE presents Mutual Fund Awards 2018. Knowledge partner, CRISIL.
Mutual funds in India complete 25 years of existence. It was in 1993 that the government allowed private sector companies to set up mutual funds, and now 25 years on, these funds have become powerful vehicles of wealth generation for citizens and a robust source of funding for economic expansion for companies as well. To celebrate the success of this industry, CNBC TV 18 has restarted its annual Mutual Fund Awards. Today I have with me our Mutual Fund Awards jury, people who have been regulators or advisors to regulators. I have with me Mr. K.N. Vaidyanathan and Sandeep Parikh, both former SEBI EDs. I also have with me Rajendra Chitale and Sailesh Haribhakti, both of whom head well-known chartered accountant and or legal advisory firms, and therefore have often been in advisory committees to regulators. Gentlemen, thank you very much for joining me in this very special chat. Mutual fund now, the viewership is expanding simply because more and more people are finding it more sensible to shift from probably bank FDs to mutual funds. So let me start exactly over there, Mr. Vaidyanathan. 25 years, 25 trillion. What is your best guess? When is the next 25 trillion coming for the industry?
Just to go with the flow of 25 years, 25 trillion and give a rhyme to it, I would say the next 25 will happen in 5.
Okay. And does the industry need to change to get that 5? Or even at current organization, you get there?
If they change and take on certain moves like adopting technology, enhancing the reach of the mutual fund industry, then that 5 could get compressed. Just ceteris paribus, current form, they should hit it in the next 5 years. Okay,
that's very good, of course, in terms of source of funding, besides, of course, wealth creation. What's your sense, Sandeep? 50 trillion, doubling, another 25 trillion in 5 years, will it be quicker, and what does the industry need to do?
No, so I'd like to make a statement on hope rather than kind of just a numerical threshold to achieve, and which is, I think a lot of the money which we have today is really outsourcing of the treasury operations of companies. So, and which is not at all sticky money. It's kind of happens for sometimes a month, sometimes a couple of quarters at most. So I would want more equity money, even more debt money, which is more retail, sticky in nature, which is really truly the translation of savings into investments. So I'm sure the current corporate trend will continue, but I hope the larger part of the increase comes from this retail side. And that's, I think, already happening to a great extent.
Well, then let me ask you a tricky question. Do you think the regulators should discourage mutual funds from accepting corporate funds? After all, what is the definition of mutual funds? It is to help people who are otherwise unsavvy, to help them invest in corporates or in, corporate bonds. Do you think it will be good if the regulator made a push and gave some negativity if you only took corporate money?
Not really. I think you want that to expand. There's no reason for a regulator to stamp down on a particular asset class and kind of investor. I'm just saying that there should be more emphasis on the retail expanding even more.
Okay. Are there other countries which discourage or in some way tell mutual funds that you better stick to retailers?
It should not. The expression you used, it is for unsavvy investors, is flawed.
Okay.
Mutual funds are investment vehicles. Savvy, unsavvy are different shades of them, different categories of them. Mutual funds are open investment vehicles and should be the channel through which, to me, the bet, when you mentioned about what can cause it to compress, and we've started seeing, is when people move away from physical assets for saving, and people kind of look at banks as efficient channels for moving money, not where you save. So the saving and investing moves to vehicles like mutual funds, then that 5 years could even get expedited.
Okay. Well, could it be, Rajendra, that technology will help the industry expand to more retailers, or will it be a disruptor?
Well, I think for sure in this industry, it's going to be only an enabler. It's very unlikely that it can be disruptor, simply because as you find the younger generation getting into a savings mode, the way SIPs have caught up, etc., I think it can only help the industry in terms of expansion. And to my mind, if at all there was a time when the mutual fund industry could have looked at its future in an unparalleled optimistic sense, it is today. I think if at all, everything is going only right for the mutual fund industry. Only time will tell whether you have to keep our fingers crossed because Sahi has worked so well, and whether therefore the extent of flows, particularly in the equity funds, will remain as robust or will remain as stable when markets are not necessarily what they are today, is all for us to kind of wait and watch. But subject to that, technology for sure, whether it is debt or equity, is only going to be an enabler.
Well, I'll make that the next discussion topic about whether it is going to be so linear.
Yep.
But Sailesh, you want to take that technology? Do you think it could get disruptive?
I think so. I'm clear that the next disruptions in the mutual fund industry will be led by technology. And it's not just technology which will enable better investor interface. It's also technology which will enable the choice of asset classes that ought to be part of the mutual fund portfolio. It's also a question of matching the risk profile of investors with the investments that you are making.
Yes.
Now, when you get into all of these issues, the mutual fund manager, the person who is actually handling the investments, will have to have a huge amount of technology backup to actually make the cut. Already we are seeing that alternative financial investments, which are very attractive, are competing for the mutual fund money. AIFs, portfolios, all of that is competing with mutual fund flows.
There is a large degree of you can say concentration risk in the mutual fund industry. Risk may be something I'm adding. Large degree of concentration of AUMs. But I think the top 7 funds account for 70% of the AUM. Between them, they are about 3 lakh crore each, or between 1.5 to 3 lakh crore each. The SEBI chairman even referred to that. Do you think that should be, wantonly made more equal?
I don't think that size by itself creates systemic risk in the mutual fund industry, which is a pass-through vehicle. Size by itself doesn't. It's pretty different from banks, which are a terminus for risks. Mutual fund is a pass-through, so size by itself doesn't. Across a number of industries, there is almost like an Olympic gold, silver, bronze race, so there will be a big gap between the big players and the others. Where size does matter is to ensure that the bad effects of size, which is oligopolistic practices, antitrust behavior, cartelization, those are things that you need to be a little more worried about, not the size per se.
Rajendra, you would be very familiar with the arguments which the banking regulator is always facing. Should we at least start thinking more deeply in mutual fund ownership as well? There could be so much of conflicted decisions. To be fair, the regulator has an eagle eye on this and technology has been a big help. But still, do we need to think through?
Well, I'm not too sure whether ownership per se, the way it is today, is really a risk factor and impediment, given that the regulations on group exposures and promoter group exposure are so low and so tight that I don't see that as a significant risk for the industry. And even if you look at what's happened in the banking industry, I think the jury is still out on whether, because of this, all has been hunky-dory where you have had broad ownership. The only merit on the wider ownership aspect is, indeed, a regulator cannot fire a shareholder. A regulator can indeed fire a CEO. Okay. That fundamental difference does exist.
Okay. You want to add to this?
Well, I want to look at it from the point of view of the investors. I think we have to stop obsessing about who owns a structure.
Okay.
No structure will be successful unless it engenders trust. It makes sure that the service expectation and the whole sense of whether you're getting the right experience is visible and is felt.
Okay.
So the entire concentration, in my view, should be on competitiveness.
Okay.
Should be on making sure that whatever promises are made are actually fulfilled to the investor.
Okay.
And the whole focus of attention of all regulation must shift
to
service and to making sure that the investor's interest is protected at all times.
That's exactly what we're going to come to. We have to take a short break, but we are coming back to see whether some fundamental requirements of the customer are served by the industry. We are back in a minute.
GIC RE presents Mutual Fund Awards 2018. Knowledge partner, CRISIL.
Welcome back to our Mutual Fund Awards special. We've been speaking with the jury of our annual Mutual Fund Awards. We discussed ownership and the growth of the industry, but now let's come to risk. First, debt risk, debt mutual fund and the possibility of systemic risk. Do you think the industry is sufficiently insulated from possibility of illiquidity, because so many of debt instruments are fundamentally illiquid, including G6?
My day job is Chief Risk Officer of the Mahindra Group, so I would never say anything is risk-free in life. So there is risk. Let's kind of look at it in three buckets. The first, I think mutual funds are doing a noble, outstanding job in maturity transformation. That the fact that the debt book is about 15 trillion rupees, 15 lakh crore, suggests that they're doing something really good, public good in maturity transformation. That has to be encouraged. Systemic risk, there is a notion that systemic risk comes from large. If you go back to 2008, what was labeled as the mutual fund crisis, the systemic risk happened when a very small mutual fund could not honor its redemption.
Yeah.
So systemic risk can come from anywhere. So
we saw it in 2008.
You saw it in 2008. So what you need to are two things. One, do the regulations on valuation ensure the pass-through nature of a mutual fund? Is the risk being borne by the investor, or is the mutual fund debt investment a surrogate for a bank deposit which has a nice linear graph with time? I think a lot of the valuation got addressed in 2010 for the mutual fund industry. The second is making a distinction between systemic liquidity and market liquidity. Mutual funds are geared to handle market liquidity, much like banks and insurance companies are geared to handle market liquidity. Systemic liquidity is a responsibility of the central bank. They have to ensure there is enough liquidity in the system. If there is a risk to systemic liquidity, let me tell you, with the depth of the debt markets we have, not just mutual funds, a lot of people will be in trouble. So I would appeal that as a country, all the regulators come together with the government to ensure that we minimize the risk of systemic liquidity. There, I think market liquidity, these guys are very good at managing.
The same question to you, Sandeep, debt mutual funds and possibility of both market risk and systemic risk.
Yeah, so in addition to what Vedi just said, I think this one additional point is in terms of not the systemic and, not the 9/11 events, but we have a lot of pressures which occur, for instance, advanced tax time, that 1 week, huge outflows which occur in the fund, in the mutual fund industry. And banks actually give lines of credit because that's a predictable kind of lack of flow out of liquidity. But those kind of issues are happening a lot. And, if so many corporates which account for 70% of the mutual fund industry all have to take out money on pretty much the same week, it has other consequences in an illiquid market. We're talking of debt here. So I think these kind of issues also need to be addressed.
If I may add, and I think it's a very good point, 2008, we all labeled it as a mutual fund crisis. But if you look at this industry in 2013, around taper tantrum, between July and September 2013, almost every mutual fund CEO and debt fund manager went home and had a good night's sleep. That's because regulations got tightened and the central bank ensured systemic liquidity. This combination really de-risked the system.
Okay. Let me now come to service standards.
What will the future be? There will be this investor with a empowered app on his or her mobile phone, which will have every possible combination of analytics to inform a particular decision. Straight through processing will make him reach to the mutual fund of choice, to the investment manager of choice, and he or she will make the investment. Also take the future as being that the whole risk profile will change, because all the big boys will have to raise money from the markets. And everything will be in terms of rated bonds. The whole debt profile of India will be represented by a whole hierarchy of debt-rated bonds. And the task will be to make sure that you're matching risk, appetite, and you're matching the quality of the investment. And the fund manager is making a sensible decision which will be fully in line.
Somehow, having covered fixed income for so long, it does look to me that this day is a little far away.
No, I mean, you'll be surprised how fast that will come.
Rajendra?
I think, to me, one of the big future risks which one needs to really ponder and contemplate over is given the kind of change which is going to happen with the need for reducing bank credit to corporate sector, and therefore they having to tap the bond market with the money flows in the mutual fund industry, you are actually going to see armchair credit selection by the mutual fund industry versus supervised credit selection by the banking industry. This, I think, is a very major change. And there is a need for a lot of introspection in the fund industry on how do you handle that.
I'm only worried about whether the fixed income market can grow in the way it is growing.
In fact, this is a risk, I'm saying. See, at the end of the day, today, the way you measure credit, irrespective of what's happening in the banking industry, is based on the fact that you're lending money, which if it goes down, it's going to hit the balance sheet of the bank. Whereas over here, it's a pass-through. And therefore, whether there is adequate, skill set to actually measure credit risk.
I agree with you.
And handle it in the long run.
I completely agree with you. And I'm telling you that this could lead to our Lehman moment. Considering that we are now in the 10th year of Lehman, what you are saying, if this is the way we progress, we better have, much more awareness and education and regulation in the industry, because that will be, could be
if I
our
may,
Lehman moment.
Notwithstanding the fact that you introduced us as ex-regulators, I do want to say that please don't paint a picture of an apocalypse.
No.
It is an issue out there. I think the key really is how do you hold fund managers accountable for fiduciary obligations?
Yes.
Which is they are acting in the best interest of investors. If you are, from a regulatory standpoint, if you are able to enforce the accountability, that will create investor confidence, that will create a maturity in the process. I believe that I don't see a challenge of skill. I don't see a challenge. I do see that competence and expertise come with time, and that is what we will have to wait out for. But the enablers would be the kind of process rigor that you can bring into it to ensure that the need to use the brakes is minimized, but there is a brake out there. I
still worry because fiduciary responsibility that are resting on the shoulders of bankers have also not been very well, discharged, and we are living at a time when there have been a spate of charge sheets against bankers, and not all of them justified, I would think, but many of them justified. So I don't think we have the time to get down that path, but it's a very interesting way forward that you are presenting, that the entire corporate funding of corporate development, economic development, may be through the mutual fund industry, or at least a large part of it. That's the great future. Very quickly, give me a one-word answer. 25 trillion in 25 years. The next 25 in how many years?
I won't say number of years, but I'd want the number of investors to expand very rapidly. Okay. So, no numerical number. Vaidhi
said 5. I'll go with that.
On the principle that the currency is trust. If we build that, it'll happen faster.
Shailesh?
Much faster.
Okay. Give me a number.
3 years.
3. Rajendra?
Maybe 5, keeping fingers crossed.
Okay. Well, gentlemen, thank you very much for participating in this conversation and, in a way, educating us and the viewers about the great future and the potential risks that the industry can face. Thank you very much for watching this very special show.
GIC RE presents Mutual Fund Awards 2018. Knowledge partner, CRISIL.
Focus. Ideate. Innovate. Enable.